Howdy there, folks. Welcome into this video here. So we got to talk about the markets, what's going on here. I got a lot of slides prepped for you guys, some pretty cool stuff I'm going to show you right off the bat. I think you guys know it based upon the title of this video. Yes, the market is now in extreme fear mode. Yes, extreme fear. I think we all kind of, can see it in the pricing action, what's going on in the market recently. A year ago, we were in about a neutral market as we are coming down off the, let's call it the peak FOMO cycle of January of 2021. A month ago, we were in a fear market. That feels about right. A week ago, we were already in extreme fear, and now we're in more extreme fear, okay? So right now, there's a market that's completely driven by the emotion of fear, and for good reason. It's not like this is just like made up stuff, right? We got inflation fear, you have the Fed fear of like how many times they'll raise and things like that, which is totally kind of messed up now with everything going on. You got a Russia situation, you got oil going crazy, right? And so when you have all that in the market at once thrown at the market, you're gonna likely be in extreme fear mode. And that's the way the market is right now, and that's just the way it is, okay? We are in extreme fear. Now, if you pull up the past 3 years of the fear and greed chart, we're the lowest we have been on extreme fear since Rona, since March of 2020. That was the last time we were this fearful in the market. And, if you compare these two time frames, right, you compare what we're going through right now versus that time frame. At that time, it was thought that businesses were going to be shut down for potentially several years. It was thought that, many businesses and even large companies were going to go completely bankrupt because they couldn't have customers, right? Think about the travel industry. It was basically, there was a time period when it was thought that every single airline, every single cruise line, every single hotel chain were going to go bankrupt completely, okay? And the reason being is at that time, when we were in peak fear, people were saying the economy was going to be closed for 3 years. Completely, okay? And so that was a thought process. Also, there was a thought process that we'd lose 5 to 10% of the population. And obviously, those didn't play out, thank goodness, but that was a thought process, okay? And so if we think about now, we absolutely have a lot to be fearful of, but the only good news is there's not a plan to have business closed for 3 years. And there's not a plan that we're going to lose 5 to 10% of the population. Well, I shouldn't say that too fast, okay? You never know with the whole situation. We won't even get into that. Let's just hope that everything, remains somewhat okay. But nonetheless, obviously, those are two very, very fearful times and for different reasons. All right. Now, if we go ahead and we pull up the Nasdaq here today, this was an interesting day in the Nasdaq. So Nasdaq, basically, it started out decent. The market dropped, right, to about 12.6. Then the market comes on a tear, an absolute tear. Next thing you know, Nasdaq's at 13.1 and some change. And that was exciting. And then the market just dropped out, and the bottom just dropped out in the market. Next thing you know, we finished the day about 12.7, which is the lowest the Nasdaq has closed in quite a while. Let's just put it that way, at least a year or so. So I gotta say, I love a day like this, and the reason being is this is what I call kind of like those capitulation type days. Obviously, yesterday was a huge down day in the market, like massive down day, right? And if you're thinking about kind of the contrarian view, you've got to get these sorts of capitulation days. So yesterday, a massive epic day, downward move, right? Today, we get this huge upward move just to be completely sold off. These are the type of signs that you're getting close to a bottom. It doesn't mean you're at a bottom. It doesn't mean like today was a bottom in the market. That's not the way this works, okay? But at the end of the day, you've got to see these type of moves to really get close to that bottom, right? You've got to see a massive sell-off one day, and then next day you see a massive bounce in the market, all to be sold off. What that tells you is that's just like Wall Street's like, you know what? Any rally, we're selling it right now. Any rally, we're selling it. And if you go back to late 2020 and into the early part of 2021, like the first month essentially, that particular market was any sell-off at all was just bought right up, okay? And they used any reason to buy up the stocks left and right? And in this market, they'll use any reason to sell off stocks. And so I like it. I actually like this sort of market because you're much more close to a bottom in this sort of market when you're seeing this type of pricing activity where there's just, they're like, oh, stocks are up, sell, because eventually that does come to a close, but you have to go through this kind of vicious period to get to that place where, finally people start saying when they see the dip, they finally start buying, right? So Nasdaq obviously has been hurt tremendously, right? You look at the heat map here today. I thought it was interesting. Microsoft and Apple finished down for the day. Those have been two of the big dogs actually holding up the market decent, along with Oracle, Adobe, and some of those stocks. They're starting to fall. And so, that's if there's another thing I want to see, it's honestly, I want to see Apple down. I want to see Microsoft down. At the end of the day, when you're going to finally end a bear cycle, everything's had to have been hit. And until you get to that moment where everything's been hit, it just doesn't feel like you're at the bottom, right? And if you have Apple holding up decent, you have Microsoft holding up decent, you have energy holding up decent, right? Well, actually, energy's doing great. I shouldn't say holding up decent. Energy's amazing right now, right? But you got some of these other big dogs holding up well. In that sort of market, it doesn't feel like you're quite at the bottom until those ones, the bottom drops out on those, and then you finally feel like, okay, we're finally at the bottom. When everything's fallen and everything's down 15, 20, 25, 30% plus, that's when you feel you're finally at the bottom, right? Now, the interesting thing will be when energy falls. So obviously energy is the hot play right now, and it should remain the hot play as long as oil continues to spike, which could last anywhere from a few weeks to a few months. So at some point, energy will fall. It will come back to Earth, right? And once again, there's no telling, when that will happen, whether that's in a few weeks from now or a few months from now. It'll be interesting to see where all the energy money rotates to, because it will rotate somewhere in the market, right? And we just don't know where. And we also, see obviously a lot of funds cashing up right now. A lot of investment banks aren't really buying the dip right now. And so it'll be interesting to see when those folks enter back into the market, where they're going to be putting their money, okay? And I think that should be really, really intriguing to see where those folks put their money. If I had to guess, it will be smalls first, okay, small caps. Then it will be super high growth companies. Then it will be big tech, big growth. And then last, it will end up flowing back into the Apples and the Microsoft and those sorts of things. It's just, that's the way we've kind of been playing out for the past year plus, where, the more speculative stocks fell first, then the rest of small caps, then high growth non-profitable, then high growth profitable, higher valuation plays, big tech start to fall, and then you just got the last few stocks kind of holding it together. And as those ones fall, it'd be interesting to see where money rotates, because that's the way the stock market kind of works. That's the way, Wall Street really likes to run portfolios, is they rotate their money around. Sometimes they rotate it to cash. Sometimes they rotate it to put options, short positions. Sometimes they'll rotate it to energy, and then all of a sudden, to more defensive plays. What was interesting today, and it's another good sign, is everything fell. That's the type of market I want to see. That, like I said, in order to hit a bottom of this market, we need everything to be damaged. Everything, it doesn't matter what it is, it needs to be damaged. In March of 2020, everything got hit. It didn't matter what your business was, you got hit, okay? In the 2008-2009 crash, everything got hit. It didn't matter what your business was, you got hit. In December of 2018, in that major correction / bear market, everything got hit. And so if you're going to end that bear cycle, everything needs to get it, okay? And that's even what we see on a day like today when you look at Walmart down, Costco down, Procter & Gamble down, Kimberly-Clark, Coca-Cola, Pepsi, everything was down. Like I said, in order to feel like you're really getting close to that dang bottom, you've got to just have everything be hit. Because the small caps already got hit, okay? And that's why you're starting to see a lot of these small caps not even really move down anymore, because they already got hit. A lot of the mid caps already got hit, right? And, Tesla got hit. A lot of these stocks got hit. Meta got hit, right? And so we need the rest of these things to get hit, okay? Next up here, I thought it was interesting, right? And if you're talking about another, potentially positive thing, the Russell was the one thing that was up today. Out of the indexes I keep on my watch list, that was the one that was green today. The Nasdaq was down, S&P 500 down, Dow was down, and there the Russell is actually finishing up today. And it could be a sign that there's definitely some money rotating there. And the Russell hit lows that was probably, maybe 4 to 6 weeks ago. And it's been holding up really decent, while the Dow and the S&P and the Nasdaq have just got pounded down, right? Now, looking at the VIX here today, VIX hit 37 today at one point in the market, actually over 37. What we're looking at here, I pulled up the last 10 years of the VIX, which is a volatility index, okay? And essentially, the market usually is trading anywhere from like a 12 to 20 over the past 10 years, right? That's like a normal market. And every once in a while, you get these insane time periods where the VIX spikes, into the way over 35. Let's just call it that, 35, 40, 45, 50, something like that. And we had one of those time periods in this time period, like kind of late summertime of 2015. That was a market that I started doing a lot of short-term trading and a lot of crap I shouldn't have been doing, and just getting in and out of the market and just acting a fool. You had a time period kind of in February, very short time, like where the VIX went crazy. You had a huge sell-off in December of 2018. We were on pace for the worst December in the history of the stock market at one point, until the very end, the very last week of December pulled us out of having the worst December in the history of the stock market. And that's VIX spiked over 35 then, right? Obviously, during Rona time, VIX spiked insane because it was like the most unknown thing we've had in a black, they call it a black swan event, when you just, you never prepared for it. And it was a once in a 100-year health event, and it caused the market to get to volatility levels that, we really haven't seen since the Great Recession. And those sorts of things, those come out every 10 to 20 years usually, to get something to have the VIX go that insane, something so out of insane that it makes the VIX spike like that, right? And then here we are recently with the VIX, here today hitting 37 plus, right? And as I say, whenever you get the VIX to spike over 35, people start making bad decisions. And the further you go over that 35, the more bad decisions people make. It's just the way it works, okay? Now, I thought this was an interesting stock to look at. Stitch Fix. They reported earnings. The stock's down under $9 after hour, okay? Now, if you look at Stitch Fix stock, right, and I know a lot of people don't even know about Stitch Fix. It's kind of a more under the radar company as of right now, based upon after hours. Their market cap's probably at $800 or $900 million. Basically, they're a clothing company that uses artificial intelligence and data to help send you clothes that you would like, okay? Not everybody's into this business model, but a lot of people do like it. And there's a lot of women out there specifically, that's their main core customer base that love this service, right? This stock has fallen over 90% 14 months. Over 90% 14 months. When you see stocks like this falling 90%, the crazy thing is Stitch Fix isn't the only stock that's fallen 90% plus over the past 14 months. There are so many stocks that are down between 70 and 95% in the past 14 months since their highs they reached in January 2021. It's insane, okay? The most insane thing we've seen since the tech bubble blew up, okay? But here's where things are really, really intriguing with this, okay? Is in the tech bubble, you had a lot of companies that had no business models, just hopes and prospects. And a lot of those companies fell, 70, 80, 90% plus. The thing with the business model like Stitch Fix, right? Which I think Stitch Fix is an interesting, buy, especially under $10. But not a stock I personally own, but I got to say I'm pretty darn interested. And if it wasn't for so many other stocks being down, I might even be a buyer tomorrow. But when I look at something like Stitch Fix, right? This is a company that has an actual legit business model. They should do over $2 billion of revenue in 2022, and they have over 4 million customers, right? This isn't like some pie in the sky, like maybe they'll have a business model someday. And no, it's not that type of business. Like they have a legit business. They're going to do $2 billion plus likely in revenue in 22. And to have 4 million plus customers is not easy. But in this sort of market, that doesn't matter. And a stock like this just absolutely devastated. 90% plus downward moves. We haven't seen moves like this in the market pretty much since the tech bubble days. That's the last time we really have seen these sorts of moves where stocks fall 90+%. Incredible. That's not sustainable, right? That's not sustainable. I'll just put it out there. Like that's not sustainable. We're in a messed up market. When you have businesses like that falling that much, we have a messed up market right now. You look at something like PayPal, and it's to say, well, who's to say Stitch Fix shouldn't be down 90+% when you've got this sort of market, right? Look at PayPal. Great business model, profit machine, cash flow machine, revenue machine. One of the most relevant companies in the world. And this stock has fallen 60+% in the past 14 months. It's fallen 50+% in the past 4 months. Incredible move down there for PayPal, right? We're in a messed up market, I can tell you that, man. Yeah, PayPal today is at a multi-year low for the stock. You have to go back to the March 2020 crash to find it this low. Before that, you got to go back to pretty much like 2018, 2019. And PayPal's made tremendous progress with their business model. They got a deal coming with Venmo and Amazon, a partnership coming this year. And does that even matter in this sort of market? No. And no one even knows how big that could be potentially for this company. That's being priced at 0 right now. All I can say about that is if you're pricing a Venmo and Amazon deal at 0, man, you don't know much about stocks. That's all I'll say about that, okay? We'll see what happens with that, but it shouldn't be priced at 0, but it is being priced at 0 right now. And this is just a messed up market. This should not be this way, okay? If you look at something like Dropbox, this stock is down 50+% in the past 6 months. Now, what has Dropbox done over the last 6 months? They've reported great numbers, great earnings. The valuation of the stock's insanely cheap. Look at the 4P. It's a joke. It's a cash flow beast. It's a profit beast. It's a consistent business model that has consistent growth. And yet this stock has fallen 50+% in the past 6 months, right? We're in a very, very messed up market right now. And, you know, there was a thought process for a while that it was only meme stocks or only like super high valuation names that were falling in this market. No, that's not the case. You got everything falling in this sort of market, and even companies that are truly great businesses. Like Dropbox is a truly great business. And, you know, it can't do anything right now. It doesn't matter what Dropbox does right now. If the market wants to send it down, the market's going to send it down. And that's when you know the market's irrational and we're in a messed up market. But it is what it is, and we have to deal with that sort of market right now. Now, I haven't pulled up forward Ps for a while on Yardini, okay? So Yardini's slacking a few days. The last update they had was back on the 4th. We're likely a lot lower than that now. We're probably at an 18.1 for large caps right now. So there's two things I think about when I think about large caps right now. One is we could still fall a little bit more on large caps. You got to understand that. This is why if the S&P 500 and the Dow fall another 5-10%, don't be surprised, okay? They could easily fall, and it doesn't mean the Nasdaq has to fall another 5-10%. It could. It doesn't mean it has to. And it doesn't mean the Russell has to fall another 5-10%. It doesn't have to. As you see a lot of days recently when the Russell's up and the markets are down. Okay, so that's some frame of mind there, right? But to think the large caps can't fall some more, you're mistaken. They could easily fall more over the next, let's call it, 4 to 12 weeks. They could easily fall more and more in a line in here. And I would love that. Because I'm starting to see a lot of large caps that are deals, but I would love it to see a lot more. And if we fall another 5-10% with large caps, we're going to see a lot more deals in the market, okay? But the good news is the trajectory is in the right direction for getting large caps more in line. I hated that the market, and I spoke about this 1,000 times in 2021, I hated that the market was trading way too rich for large caps. It didn't make me feel comfortable, I can tell you that much, because you know every time large caps get way up there, to 25, 26, 24, 23, you know it's just a matter of time before it falls, right? And the market will find its reasons to get there, right? And the market ended up finding those reasons. It found inflation. It found, rate increases. It found the Russia situation. It found oil going up. The market found its reasons, and if it wasn't for those reasons, it would have found some other reason to drop this market. It's the way it always works, okay? No, S&P 600, small cap, we're trading somewhere in here. Now, if we go back and we go to every single time frame where the S&P 600 small caps were trading this cheap, every single time we're about to make a massive bull run, okay? So back in 2002, 2003, after we went through the tech bubble smashing, that was ugly, okay? Huge buy the dip opportunity and the market went beast mode, okay? In 08, 09, the small cap went, the 4Ps went way low. And guess what? Huge buy the dip opportunity, and we went on a massive bull run. 2011 into kind of early 2012, S&P small caps fell big, and we went on a massive bull run coming out of that for the next couple of years. And in March of 2020, guess what happened? Small caps fell huge to, insanely low valuations, and then we went on a massive bull run. It never fails. Every single time over the past 20 plus years that small caps start trading under 14, huge buy the dip opportunity, and you're setting up for a massive bull run. And it's just like, and the thing is, you can trade in these ranges for, a few months. And I think that's the part where people want to, are very tempted to play call options because they're looking at this and they're like, dude, we're setting up for a massive bull run. Yes, we are. But the thing is, you don't know exactly when that's going to play out. You can go through several months, right? You can go through a 6-month span of, small caps trading this cheap. And eventually, you're going to go on that massive bull run, but you don't know exactly when it's going to happen. Does it happen in a month from now? Does it happen in a week from now? Does it, when in terms of when that bull cycle starts? Is it a week from now? Is it a month from now? Is it 3 months from now? 6 months from now? 9 months from now? We don't know. We just know we're going to go on it. We just don't know. It's kind of like going on a roller coaster in the dark, right? Imagine going on a roller coaster in the dark and you're like, okay, when's something scary going to happen? Imagine you're just coasting and then all of a sudden, woo, and you do something crazy and you lose your mind. That's the stock market we're in right now, where we're going to go on a massive bull cycle, but we don't know exactly when this baby's going to start. We just know it's going to start, okay? Now, if you pull up PEG ratio, so price to earnings growth, unfortunately, Yardini, come on, Yardini, we got to update these more often. They didn't update it since, February. So right now we're trading somewhere in here, in my opinion, probably a little above a 1 range. And once again, every single time, and this goes back to 25 plus years in the past, every time price to earnings growth gets around here or under, huge buy the dip opportunity. It happened in 08, it happened in 09, it happened in 2011 and 2012, right? It happened in December of 2018 into the early part of 2019. And every single time we went on a massive bull run coming out of that, and then we're setting up for the exact same situation again, right? Where, PEG ratio is insanely low and we're going to be ready to make a crazy tear to the upside. Margin debt. So margin debt. We have some good news about margin debt. So unfortunately, this isn't Yarndini's fault, by the way. It's just margin debt always is like a lagging indicator. Margin debt's been skyrocketing kind of down recently. And so January, that's where the numbers were there. In my opinion, if we had an updated one today as of March of 2022, right? We'd be somewhere between this and this, roughly right now, if we had an updated March of 2022 numbers. So the good news is, we're getting to a much healthier market now, right? Where large caps that have been trading insanely rich are now at coming in line with where they should be and should come in line a little bit more. Margin debt skyrocketing down, which I think is very, very healthy. We're in extreme fear in the market, and the most fearful the market's been at any point in the past 3 years outside of March of 2020. I think that's a good thing. I like a market that's scared. It makes me feel more comfortable because I know eventually that extreme fear starts to moderate and starts to go more to neutral. And then from neutral, it starts to go to, a little more toward greed. And so next thing you know, all of a sudden stocks start moving in the right direction. So everything in this market's lining up exactly how I like it. You just have to be prepared for, the roller coaster ride that is the market right now and not get too caught up into the moves up or down and not too scared of the market and things like that. And you got to take advantage of deals in this sort of market because there's a lot of steal deals out there. And I can tell you they won't remain steal deals forever. You can get these time periods for, 3, 6, 9 months and then they're gone. And next thing you know, you're on a massive bull run again and everybody's like, oh man, I missed the dip. Okay. So yeah, hope you guys enjoyed this video. As always, I got a sick free course right now. I figure with the market being kind of in a rough place right now, why not make a course free? So we made Stock Market Investing Mastery. That's a good beginner course for anybody that's been in the market for less than 2 years. There'll be pinned comment down there. Also, take advantage of some free stocks from Moomoo. They got an exclusive deal going on right now. I don't know how much longer that's going to last. But basically, you deposit any amount of money. And you get a free stock worth $3 to $3,500. You also get a free stock worth $9 to $3,500. And you also get a free NEO share. So it's pretty darn amazing. That's with a deposit of any amount through Moomoo, through my pinned comment down there. Much love and have a great day.